Hello viewers, welcome back to my channel, Booyah. Let's talk about the hottest thing in ETFs right now. The YieldMax NVDA Option Income Strategy ETF, ticker NVDY. This bad boy is turning heads faster than a cat video on TikTok. Why? Because it's promising a dividend yield that'll make your grandmother's savings account look like chump change. NVDY is all about Nvidia, baby. You know, the company that's been hotter than a jalapeno in a heat wave thanks to the AI boom. This ETF isn't just buying Nvidia stock though. Oh no, it's getting fancy with options. The goal? To generate more monthly income than a winning lottery ticket. But as with any magic trick, there's always a catch. So buckle up, because we're about to take a wild ride through the world of synthetic covered calls and option premiums. Let's dive in. Alright folks, it's time to put on your thinking caps. We're about to dive into the secret sauce behind NVDY's eye-popping yield, the synthetic covered call strategy. Now don't let the fancy name scare you, it's not as complicated as it sounds. A regular covered call strategy involves owning shares of a stock and selling call options on those shares. It's like renting out your house while you still own it. A synthetic covered call takes this idea and puts it on steroids. Instead of actually owning Nvidia shares, NVDY uses something called a synthetic long position. This involves buying call options and selling put options with the same strike price and expiration date. On top of this synthetic long position, NVDY sells out-of-the-money call options. This is where the income comes from. Now let's talk about that juicy 48% dividend yield. It's the kind of number that makes investors drool and financial advisors break out in a cold sweat. But where does it come from? Is it sustainable? Let's break it down, folks. NVDY's yield comes primarily from the premiums it collects from selling those call options we talked about earlier. Here's the kicker. Nvidia's been more volatile than a cat in a room full of rocking chairs. High volatility means higher option premiums. It's like selling hurricane insurance in Florida during storm season. Now, that 48% yield, it's based on past performance, and as we all know, past performance doesn't guarantee future results. NVDY's yield could drop faster than a lead balloon if Nvidia's volatility decreases, or if the stock price moves unfavorably. So keep your expectations in check. Let's dive deeper into the engine that powers NVDY's monster yield option premiums. These aren't your run-of-the-mill dividends, folks. We're talking about cold, hard cash generated from selling call options. Every month, NVDY sells call options on its synthetic long position Nvidia. These options give buyers the right to purchase Nvidia at a specific price, the strike price, before a certain date. In return, NVDY pockets the premium paid for these options. The amount of premium NVDY collects depends on a few factors. The biggest one? Volatility. But here's the catch. NVDY doesn't get to keep all of this premium as profit. The rest? That's what gets distributed to shareholders as that mouth-watering yield. Section 5. Risks associated with NVDY investment. Now let's talk about the elephant in the room. Risk. NVDY might look like a golden goose, but it's got more risk than a tightrope walker in a hurricane. First off, we're dealing with options here, folks. Options are like nitroglycerin powerful, but handle them wrong and boom. The biggest risk? Nvidia's stock price taking a nosedive faster than a skydiver without a parachute. If that happens, NVDY's synthetic long position could lose value quicker than you can say margin call. And remember those put options they sold? In a major downturn, they'd be on the hook to buy Nvidia at the strike price, even if the market price is much lower. Then there's the risk of missing out on big gains. Sure, NVDY collects those sweet option premiums, but if Nvidia's stock goes to the moon, NVDY's upside is capped. Let's not forget about concentration risk. If anything goes wrong with Nvidia, a bad earnings report, a competitor's breakthrough, or just a shift in market sentiment, NVDY could be in for a world of hurt. Section 6. Potential losses in a bearish market. Alright folks, it's time to put on our bear suits and imagine a world where Nvidia isn't the darling of Wall Street anymore. What happens to NVDY then? Well, let me tell you, it ain't pretty. In a bearish market for Nvidia, NVDY could face losses on multiple fronts. First, that synthetic long position we talked about, it would lose value faster than ice cream on a hot sidewalk. As Nvidia's stock price drops, the call options NVDY bought become less valuable, while the put options they sold become more expensive to buy back. But wait, there's more. Remember those call options NVDY sells to generate income? In a falling market, they might not be worth much. This means less premium income, which could lead to a drop in those juicy distributions. The synthetic position needs to be rolled over periodically, which means realizing losses if the market is down. It's like being forced to sell your house in a down market, even if you'd rather wait for prices to recover. Section 7. Capped gains in a bullish scenario. Now, let's flip the script and imagine Nvidia's stock taking off like a rocket. You'd think NVDY would be popping champagne, right? Well, not so fast. This ETF's upside is more limited than a kid in a candy store with only $1 to spend. In a bullish scenario, Nvidia's stock price could soar past the strike price of the call options NVDY sold. When this happens, those options are likely to be exercised. This means NVDY has to deliver Nvidia shares at the strike price even if the market price is much higher. Sure, NVDY's synthetic long position will increase in value as Nvidia's stock rises, but remember, they've capped their upside by selling those call options. In a year where Nvidia's stock doubles or triples, NVDY might only see a fraction of those gains. Section 8. The impact of NVDY's expense ratio. Now let's talk about something that'll make your wallet wince. NVDY's expense ratio. At 0.99%, it's higher than a cat on a hot tin roof. This expense ratio means that for every $100 you invest, almost a full dollar goes to managing the fund each year. It's like a never-ending toll on the highway to returns. Over time, this can eat into your profits faster than termites in a lumberyard. And remember, this is on top of any trading costs or taxes you might incur. Why so high? Well, running this kind of complex option strategy isn't cheap. The fund managers are constantly buying and selling options, adjusting positions, and trying to squeeze every bit of yield they can out of Nvidia's volatility. In years when returns are low, that 0.99% is going to hurt even more. Section 9. Expert opinions, the bull case for NVDY. Now let's hear from the bulls. Some experts are more excited about NVDY than a kid on Christmas morning. They argue that in a world of low yields, NVDY offers a unique opportunity for income-hungry investors. One bull we spoke to, let's call him Optimistic Otto, pointed out that NVDY's strategy allows investors to benefit from Nvidia's growth potential while also generating substantial income. Another expert, we'll name her Bullish Betty, emphasized the diversification benefits. For investors who already own Nvidia stock, NVDY offers a way to generate income without selling shares, Betty explained. The bulls also point out that NVDY's option strategy can provide some downside protection in choppy markets. The income from option premiums can help cushion the blow if Nvidia's stock takes a hit, Otto noted. It's like having a safety net while walking a tightrope. You hope you won't need it, but it's nice to know it's there. Section 10. Expert opinions. The bear case against NVDY. But hold your horses, folks, not everyone's drinking the NVDY Kool-Aid. The bears are growling, and they've got some points that'll make you think twice before jumping on the NVDY bandwagon. First up is Cautious Carl, a veteran fund manager who's seen more market cycles than a laundromat. NVDY's yield is unsustainable, Carl warns. It's based on Nvidia's unusually high volatility. When that calms down and those juicy premiums will dry up faster than a puddle in the Sahara. Then there's Skeptical Sally, a risk analyst who's more paranoid than a squirrel in a dog park. The concentration risk is off the charts, Sally frets. Section 11. Conclusion. Is NVDY worth the investment? Alright folks, we've taken this roller coaster ride through the world of NVDY and now it's time to get off and decide if we want to buy another ticket. Is NVDY worth the investment? Well, as I always say, it depends on your situation faster than a chameleon changes colors. For the risk takers out there, the thrill seekers who like their investments spicy, NVDY might be right up your alley. That high yield is tempting, like a siren song for your portfolio. But remember, high reward comes with high risk. It's like skydiving, exhilarating, but not for the faint of heart. On the flip side, if you're the type who gets queasy on a merry-go-round, NVDY might give you more sleepless nights than a gallon of espresso. The complexity, the concentration risk, the potential for big swings, it's enough to make a conservative investor break out in hives. NVDY is a specialized tool, not a cure-all for your portfolio. It might have a place as a small part of a well-diversified investment strategy, but it's not something to bet the farm on.